Yeah, well,
Just for the record.
okay, to make the record. Most important part is the gentleman. I just want to make a few introductions. Okay. Im Namen von der BCW begrüße ich Sie ganz recht herzlich zu unserer Präsentation über indirekte Real Estate, wo die BCW eine langjährige, jahrzehntelange Expertise hat im Verwalten von indirekten Immobilienanlagen, vor allem in der Schweiz. Und wir haben das jüngste Expertise in diesem Bereich haben wir dürfen lancieren im Bereich internationale Indirect Real Estate Strategien und mit dem Lead Portfolio Manager Dr. Guerra hier können wir Ihnen mehr über die Expertise, aber speziell auch die Opportunitäten in dem Markt erzählen. Und wenn Sie die Präsentation gerne hätten, Sie können die Business Card von Ihnen vom Stuhl lassen und dann tun wir Ihnen das gerne nachträglich dann noch zusenden. With this word, we will have the presentation in English or in Italian. That would be an option. But yes, please, Roger, and for any question, please let us know. We will be happy to answer that.
Thank you very much, Karine. So, welcome everybody. Happy to be here to speak to you about direct international real estate. So, as Karine mentioned, we are quite active at BCV since more than 25 years on the Swiss real estate market. We are very active with institutional clients. We know them quite well in their needs of real estate exposure. But we have a new endeavor now on the international real estate. And we think that today it's a good opportunity, it's a good timing to look at indirect international real estate. Here we are. So I'm Roger Guerra. I'm part of the indirect real estate team at BCV. I lead the international investments. We have 4 other persons looking mainly about Swiss real estate, but we are an integrated team and we work all together on the indirect real estate investments for BCV. The idea for me today is to show you why we think that today is a good opportunity to invest in indirect international real estate. There are reasons that are structural, so they are valid all the time, and then we have a more timing-oriented opportunity, which is given by market behavior in the last few years in the international real estate, which is a little bit different from Switzerland. It's why I will compare Swiss real estate with international real estate. I give you a little bit of both sides to understand why we think that we should, for institutional clients, add an exposure to international real estate in their portfolio. So as you're probably aware, Swiss institutional clients are very largely exposed to real estate in their portfolio. I use here the data from the Swiss Canto study on the Swiss pension funds. So Swiss real estate is almost 25% of portfolios in institutional clients' portfolio. So it's a very large exposure to real estate in institutional clients' portfolio, but very little in international. Today, the main exposure is through direct holdings in assets, in real estate assets. That's something that has been there since a while, has been decreasing over time because it becomes more and more difficult to find good assets and to continue to be able to deploy the capital into the direct investment. So the part of indirect real estate exposure has increased over the years and is today larger than the direct holdings for pension funds. In this case, that's pension funds. There will always be a mix, but we have always, over the last 10 years, been around 25% in real estate. But very little exposure to international real estate. So portfolios today in pension funds do hold on average 2.5% compared to the within the 25% of total real estate, so very limited exposure. Why this is the case? Probably 3 main reasons. One is proximity. So institutional clients, like I understand Switzerland, so they prefer to be exposed to Swiss real estate. Secondly, they better know the Swiss real estate market than international. And third, international real estate includes also FX risk, so a currency exposure that some of the clients, of the institutional clients, don't want to bear on their portfolio. But as we see, over time, allocation to international real estate has grown with the increase of allocation to real estate as a whole in the portfolio. On the international side, these exposures are mainly obtained through indirect real estate. So pension funds don't like to go outside Switzerland to buy an asset, a building, a logistic warehouse or something like that. That's much more difficult to have this in their portfolio. So they, with their exposure, they tend to have indirect real estate exposure. So they will ask to work with either a fund that invests directly abroad or with portfolio funds. So fund of funds, typically it's another exposure that they have in their portfolio. It's quite interesting. The smaller pension funds tend to have a little bit more exposure to international than the larger one. It's not exactly clear why, but there is a trend that has been like this over time. I mentioned that we see two types of reason to be invested in international real estate. One are structural factors, which are there all the time. So are there mainly to diversify the portfolio of Swiss real estate. So the idea is to explain why we think that it makes sense all the time to have an exposure to international real estate, and then also explain on a second time why today is the right moment to try to enter in this market. So the first main reason, it's quite clear, size of the market. Swiss real estate market is very large. If we take listed funds and investment foundations, we are about 190 billion Swiss francs of real estate. But if you take the global indirect real estate market, you end up with 900 billion of real estate. So suddenly you have a much larger playground to play and have much more diversification opportunities in your portfolio. With risks, that's clear, but at least you can choose among the different exposure that you would like to have. Just a note, these graphs don't take into account listed companies. So there is an additional layer of potential exposure that you can have. It's through REITs around the world or listed companies in Switzerland. This is just funds and investment foundation, so the total universe is much larger than that. US dominate the size of the international market, but not the number of available vehicles to invest. So we see that the US vehicles are only 45 in this index, on this universe that is presented, while Europe, which has a smaller size in terms of total assets, has much larger number of funds, so more opportunities available in that space. Asia Pacific is a little bit smaller, and it's even smaller than the Swiss market. So gives you an idea of the size of the Swiss market as a whole. We can estimate that these numbers underestimate the real size of the indirect real estate market internationally, because typically not all the funds reports to the indexes and to the universe that we present. Second element, it's transparency. Swiss market, it's well known to Swiss people, but when you take international comparison, and that's a study that is produced annually by John Lang LaSalle, one of the biggest real estate companies in the world, they try to quantify by using quantitative and qualitative measures the transparency of the world real estate markets. And it's quite interesting to see that Switzerland is quite well ranked, 17, but it's not within the top ranked countries, which are called the highly transparent countries. Switzerland is in the second group, which is the transparent companies. That's more a question of, and I mentioned before, below, it's just because technically they have less, they rank less in the ranking of market fundamentals and typically sustainability. So that's a lot of things to do to catch up and to be in the future possibly in the higher ranking of this index. Also, and we see it when we discuss with Swiss real estate managers and international real estate managers, and that's a general comment I can do, information that we obtain in the institutionalized international real estate manager, it's much more deeper than what we can get in Switzerland. So there is already in the market itself and the discussion that we have with managers, more information to get internationally than in Switzerland. It's not generalized, so there are better companies than others, but in general, on average, we can see that the information provided is a little bit less detailed in Switzerland than international. So access international real estate market is also accessing more transparent markets. So the second factor or reason to be exposed to international real estate market. Another factor is sector exposure. Swiss real estate market is typically a concentrated market. 2/3 are in residential assets. Very stable, income producing. That's something that Swiss institutional clients do like and are happy to own in their portfolio. But there is a larger spectrum of sectors in which you can invest internationally, so get other drivers of performance, other drivers of diversification, which you cannot find in Switzerland. So typically we can see that in international you have much larger exposure to logistics, to office. Well, that's maybe not what you want to have actually in the portfolios, but lower exposure to residential and more exposure to what we call other sectors or alternative sectors. That's something that in Switzerland is very limited. We have some other exposure which is mainly hospitality and some land, but abroad you can find sectors like self-storage, data centers, medical office. So there's sectors that offer the diversification power that we don't have in Switzerland. So open up to international will give also access to buildings and assets that you cannot find in Switzerland. And regionally, you also have quite large diversity in terms of sector exposure. So it's also interesting to note that having a portfolio that covers all the regions offers an additional layer of diversification in the portfolio of a client. So Asia Pacific is much more exposed to office. US and Europe were larger in office, but have seen valuation going down very dramatically in the last 2 years. So the part of office in the indirect market is much smaller. But you have very large exposure to logistics in the US and quite large in Asia too, while Europe, this exposure is much smaller. As a whole, being exposed to international gives diversification in terms of sector exposure. We also can see that over time, this allocation in the funds that you can buy abroad is much more dynamic than in Switzerland. The Swiss market is stable, it's boring, but it's nice to have a boring market in this respect. But it's really residential assets and not more else, and has not evolved a lot over time. Abroad, you have much more larger divergence over time, and you can see that you have new sectors coming in, allocation that changes, and given also valuation that move around much quicker than in Switzerland, you have also adjustment in the indirect portfolios internationally that are driven by valuation declines or increase on some stage. So you have internationally, you have also a more dynamic market where you can access and see new opportunities in new sectors that are coming in. What we are seeing internationally that we not experience in Switzerland is that also the index providers are updating their view of the market, so adding new sectors to their main list of available sectors. Typically in the US, the new NCREIF index that has been released this year includes sectors like senior housing, self-storage, and the other sectors that include typically medical office and data centers. So the reference of the market is also evolving abroad, and what it's also interesting be that push funds and managers to add new asset classes into the portfolios. I have also put a mapping of the US real estate sectors. We see how far the granularity in the different sectors can go in the US. Typically, if we take the residential market, which is the main the main Swiss market, in the US, you clearly have multi-family condos, but you can also have student housing, senior housing, single-family rental. That's a new market that is evolving quite quickly, where the managers own a group of single house that they rented to families. That's a new market that is an expansion, given that in the US, typically families have no more the financial power to buy, and so they prefer to rent and to rent single-family houses rather than to be into a multi-family condos. Then you have sectors like a little bit more different, boat and vehicles storage, data centers, but then you have some new sectors that are coming into the markets that will expand the universe of investment available abroad and given more potential for the managers to diversify their own portfolios. So the idea is really to show you that there is a world of new opportunities that opens up when you go outside Switzerland. Second element is market timing. Swiss market, we see, I traced the green line is the investment foundations, so the CAGAST index. The gray one is the Swiss, so the Swiss Real Estate Fund Index. We see that foundations are very stable. It's more a proxy of the real physical real estate investment. 5% per year, more or less 3% of income, 2% of NAV adjustments, so valuation improvements. And then you have the more volatile listed funds that at the end, on a longer term, will give you the same kind of results, but with much more short-term volatility. So introducing there the concept of discount and premium in that market. So what is moving around the market on the listed side, it's more the market component rather than the underlying real estate exposure. We see that given increasing inflation, end of 2021, market has corrected quite significantly, going down more than 20%. But also, once the view was a little bit clear of the future and the inflation started to slow down, the market reacted very strongly. Last year, listed funds had a record year with 18% of return for investors. So it's much more volatile, but at the end, you will have, on a longer term, a real estate return. If you look at the composition of the listed real estate returns, we have three components. As I mentioned, there is the real estate component, income, NAV appreciation, and then you have the premiums. We see that over time, the dark green are dividends, so the income side. The light green are the NAV adjustment over time. These are very stable, change very little over time. Dividend is 3% per year. NAV adjustment is on average over, it's more almost 20 years, it's 2%, with some years where you have negative appreciation, but very limited. Again, 2022, 2023, or 24, adjustment in NAV of funds have been very smooth and not really negative for most of the funds. What is creating volatility in the market is purely the discount and the premium that you have. That's more the stock market component. We all know the evolution of interest rates and inflation in the different countries around the world. We know that inflation started to creep up in 2021, ended to be at the highest level in 2022, and then with the start of restrictive monetary policy around the world, inflation started to gently come down. In some regions like the US, has gone up and down quite significantly, but we are still not back to the previous levels. Switzerland has done quite a nice job in terms of keeping the inflation low, and we are today more or less lower than 1%, and the rates have gone down also very significantly. In Asia, Japan is maybe the exception of all the countries. Inflation has gone up. They have a long period of deflation there, but interest rates have not moved around until 2024, when BOJ started to increase their rates. So the impact on inflation there is still limited, while in Australia we had a jump in inflation, an increase in the rates, and we are starting to see now, so only now, some decrease, so rates cuts. So the Australian market starts to become also interesting in that respect, because we have the movement on the downside of the rates. How Switzerland behaved on that time? Again, the listed market performance, we had a decrease of 25% when the inflation started to go up on the listed market, and then a rebound after inflation started to slow down. But the interesting line is the green one. That's the NAV of the funds in the index. So it's the underlying value of the assets of the index. You see that the value of assets has increased on a very stable manner over 20 years, sorry. And even when inflation started to go up, rates have gone up, the impact of on the valuation of funds has been very stable. So limited adjustment, 1.5%, 2% in some funds, but not more than that. That's also a situation in Switzerland, because valuers tend to be much more smoother in adjusting valuation, so it takes much more time before they start to say, okay, maybe we have to reduce a little bit valuation. It takes time to that, and then finally, as we had an adjustment in inflation, the curve started to come up again, and then we are again on a positive side today. We are seeing the last valuation coming out from the different funds, and we are again on a positive trend on that side. So finally, what has been a very bumpy road for the listed funds has been very limited in terms of underlying asset valuation, which have been stable over time. Internationally, it's not the same situation. 2022, rates, inflation went up. Markets reacted very, very dramatically on the valuation side too. Not only the listed market, but also on the NAV valuation, the NAV value of all the assets in the underlying the funds internationally have gone down quite significantly. Europe funds have experienced minus 11%, US minus 19%. Asia Pacific, as there are markets that have not really experienced the same type of political of inflation and monetary policy, have not moved around that much, but still minus 8.5%. We see now that after this decrease, there is the first signs of a rebound. In Europe, this has started mid of 2024, so the first positive quarter was June 2024. The US are just coming there now, so we see that, and there is potentially a catch-up opportunity if you invest internationally. Asia Pacific is a bit more limited. Again, Japan, which is a big market, has not really adjusted because inflation and rates have not gone up as much, while Australia has seen very large adjustment in the market. Sector-wise also, adjustment have been quite dramatic. If you take office, which is the hated sector today and mainly in the US, it went down 36%. We are still not at the end of the journey, probably in the US. What we hear is that there will be at least 1, 2, 3 more quarters of downgrading valuations, and then potentially stabilization. European offices have also corrected very dramatically and quickly. That's also a difference between Switzerland. Valuation have been adjusted very soon and have been taken a very high hit. Other sectors have been a little bit more resilient. Typically retail, if you take in the US, retail had corrected well before. E-commerce, and then also COVID, all that had already made the valuation going down dramatically, and finally interest increase has not really had an impact, an important impact on the US retail on that side. I said that we see some signs of rebound in the international real estate market. If I take as a proxy of the potential rebound that we can see, the listed equity market, so the REITs market in the different regions, we see that in the US, after a huge drop, we are now seeing, we have seen a strong rebound in the listed market. Listed market tends to be an advanced indicator of the physical market, so we can expect at some stage to see an adjustment. It will probably not be as steep as it was for the listed market, but at least there is a potential to catch up on that space. Europe is the same, very sharp decline in the listed market, some stable returns over 1 year, and then a rebound end of 2023, early 2004. We have just now started to see, since a few quarters, a rebound in the physical market too. So there are signs that we should see an improvement in the international real estate market, giving an opportunity to be exposed to something that is rebounding in the future. As mentioned, Asia Pacific remains a separate case, just because there are a mix of countries that have different, there are in different period of their cycle, so it's not exactly the same type of behavior, but we are seeing a rebound, and as I mentioned, Australian rates are coming down, and so we hear from the managers then there are opportunities to catch up also on that space. That was the indicator from the listed market. We now are, if you look at the transaction price of the last few quarters, and this is data from Green Street, we start to see a rebound in prices in the US and the European market. It's not that pronounced, but it's coming. So, which means that we can expect that even the funds that own these assets in their portfolio at some stage will see their own valuation going up as the transactions are showing that prices are improving in this market. So the physical market is improving, but it's not yet back to what we had before. Mind of time. Transaction volumes, another signs of that thing, that situation is improving. We are seeing a slight increase in transaction in the US and in Europe. So this is positive for the underlying real estate market, and it's potential positive for an investment in that markets. And new supply, which has been quite large up to 2022, is declining very strongly in most markets. Replacement cost for buildings is still very high, so building new buildings or assets is not worth today, so people are not launching new projects, and we will see a decline in new supply hitting the market in the US and Europe. Reduced supply, renewed demand because the asset classes are gaining interest, we could expect some increase in prices in the coming quarters. Finally, I found two studies that speak about potential returns. I say potential returns once you enter early in a rebound market. We see historically that, and that's for the US real estate market, after each recession and after each real estate market downturn, we have seen huge adjustment on the positive side in the following years. We had very large positive markets over time. Doesn't mean that we will have the same kind of rebound today or the same length of the rebound in the coming years, but there is signs that, and histories tell us that at some stage you can catch up and have a nice returns if you invest when you are at the bottom. The second chart the second chart shows the returns based on the vintage where you invest. So the blue lines are the ones that are the vintage that offer an above average return once you invest. You can see that there is not 1 or 2 bars. The number of vintage that offer an opportunity to beat the average returns over time are quite there is a quite large number of quarters. So there is opportunity even if you don't enter at the bottom of the cycle, but at least you know that coming in a few quarters after that, you will be able to generate above average returns too. So another element in favor of saying, okay, today it's maybe a good timing. It's probably not the bottom. It's not the best timing, but will generate at least potentially above average returns for the coming years as well. How we invest in the international real estate market? As mentioned, that this is purely indirect real estate market, so we buy funds. How you can get exposed? You can either be exposed through debt, so funds that invest in real estate debt, or through equity, so the funds own the building itself. And then you can choose either being exposed to public or private markets. Debt funds will benefit from an improvement in valuation, but more in terms of risks that going down because the value of the pledge is increasing, so they take less risk by lending money to the managers, to the investor in the real estate. So that's interesting, but it's more an indirect benefit, and you are not really taking advantage of the direct improvement in the valuation. So the equity side is offering this. You're investing in funds that buy buildings. So if the value of buildings is going up, then you have directly an impact on your fund valuation and your fund NAV. So that's, for us today, the most appealing opportunities to be on the equity side. You can then choose between public equity, public real estate equity, or private real estate equity. Then you have to make a trade-off. Either you like liquidity or you like volatility. See, if you want to avoid volatility and you are happy to be exposed on a longer term, the private equity sector is the best one, and that's also where we invest today, because institutional clients can have a longer horizon, don't need necessarily to come out of their investments after 1, 2, 3 months. So they have the investment horizon that allows them to be exposed to less liquidity, but also to less volatility. So typically, it's what we favor today in our portfolios. And finally, what kind of real estate do we select? We prefer to go to core plus managers. Why? Because typically, these are managers that invest in the best location, so assets with the highest occupancy rate, with good income generation, and with the best quality of assets that you can find. So typically also including ESG factors in that. So these are the less risky investment in the international real estate, which is also probably the most closest way of investing internationally compared to the Swiss real estate market. So main kind of risk profile, risk return profile, but on the international market. And we do it by investing in portfolio funds. So we want to have diversification. We want to diversify the risk of the manager that we select, of the exposure that we have, the geographical exposure, the sector exposure, financing, typically, depending on the region, the countries, we have different financing risk, operational risks too. So the idea is really to construct a portfolio of funds that diversify all this risk. So that's our way to propose to institutional clients in Switzerland to get an exposure to international real estate. So if I have to conclude, and then I will be happy to have questions. Sorry, it was a bit long. 2 elements. Indirect international real estate, it's a good complement to a Swiss real estate portfolio. It gives diversification, and this is something that you will have anyway, even if markets are not in their best cycle. And then today, we have seen that there is a potential of catch-up. We don't expect to make 10, 20% per year in the coming years, but we will have our stable return from the core investments, which is income and some NAV appreciation, as core funds tend to have an income growth over time and then generate some NAV appreciation. And if the market recognize the value of previous years, then we will have also catch up in terms of valuation and then an additional layer of potential return. So I don't know if there are any questions. I spoke a lot. Yes?
You're looking for diversification?
Yes.
Are you looking to overweight certain sectors or certain region or in your allocation?
Yes, so today we prefer Europe and US towards Asia because Europe has already started the cycle of, we expect the rebound in valuation. US, they are somewhere at the bottom of the cycle. So these are the two regions that we prefer. We have an overweight in these two regions today. In terms of sectors, we tend to select managers that have a diversified approach in terms of sectors. So our leeway is a little bit lower because we delegate somehow part of the sector allocation to the managers, but we will select a manager based on their actual exposure to be a little more exposed to what is technically what we are hearing the best sector to be today in the US and in Europe is probably logistic and residential. So we want managers that have an exposure and higher exposure into these sectors and potentially adding some return from alternative sectors. So that's something also that we push and try to add to our portfolio. Yes?
One question, I fully buy into your investment thesis. I believe it's fantastic, very attractive market, for real estate. When a client asks you whether you should go hedged or unhedged,
As a fund manager, and at the end, the client will see your performance. I'll be happy to say, go unhedged, because this is a class, clearly you will have higher returns, at least face returns, but also this is an illiquid market. So hedging an illiquid market, we can do it, but this an impact also on our investment power, because we have to keep cash to face the hedging cost and the potential margin cost that margin request that we have. So we push our clients to be exposed to we have a US dollar class, to the US dollar class, because anyway you have most of the investment except Europe that are exposed, US based. But I can understand that institutional clients do prefer have Swiss hedge exposure, but we propose to make this hedging outside our product, just because if they ask us to do it internally, then they will also have a reduction in the potential of returns, because we can invest less. But yes, the risk of hedging is there. We have seen that the dollar has gone up quite a lot last year. This has impacted, at least on the fourth quarter, has impacted most of the funds that were exposed to other currency. Asia has been hit quite dramatically due to the dollar appreciation. There has been a little bit of turnaround in this quarter, also the first quarter, but we are also hearing the managers telling us dollar is very strong, so there is potential to have limited additional appreciation of the dollar. So we can only push clients to go to keep a local currency rather than to have a hedge currency exposure.
What I didn't really understand is in terms of sector allocation.
Yeah.
I think there's a lot of good managers out there that specialize in, as you said, for example, logistics, office, residential, etc.
Mm-hmm.
But I think there's also a lot of funds, especially in Europe, as you pointed out, with a wide array of different sectors. Don't you think it's, from a manager selection point of view, it's kind of creating an edge if you go for best-in-class managers, and you do the proportions alongside your estimation.
Yes, no, I understand, and you're right. You can find and select good sector-focused manager and do your own adjustment. We have chosen to start by investing in diversified funds because it will be easier for diversified funds to move around their exposure into sectors than us starting to redeem over time one fund because we think that we want to reduce logistic in favor of office or retail. And this will take us more time at some stage to do that. Doesn't mean that we don't want to select sector-specific funds. We will do it. That will help us giving a kick to the portfolio at some stage. But we prefer today to benefit of the rebound just being exposed to a diversified portfolio. But I agree that you can find very good managers that focus on one sector. And if you are not looking at moving around your sector exposure over time, that's probably the best solution to implement an investment. We just want to keep this small flexibility that is given by managers that can then sell and buy assets quicker than us coming out and invest in new funds. It's just a matter of how we construct the portfolio, but I agree with your remark. You can have very good managers on a sector-specific side. No other question. Thank you very much for your attention. And don't hesitate if you have any other question to speak out.